If you've been asking yourself, is it time to incorporate my business? And you went to your accountant and you got the answer, it depends, then this video is for you. Because today we're going to talk about what are the pros and cons of being a sole proprietor in Canada versus an incorporated entity in Canada. And we're going to discuss so that you can make an educated decision. And I'm also going to answer the question of why your accountant says it depends. But before we get into that, if you've never met me before, hi, nice to meet you. My name is Janet Mercredi, and I help Gen X small business owners run their businesses smarter, make more money, and get their time back. And I do all of that by guiding them to implement the Profit First system into their businesses so that they can use their business as a tool to fuel their personal freedom. So one advantage to having a sole proprietorship business is low cost of entry. You could literally use your personal name. You don't even need a business name. It's a nice to have. You can, but you don't need it. You need a business number, but you don't need a business name. So you can sell products and services in your personal name, collect the money, pay the expenses of what it costs to do that service, and then claim it on your personal tax return at the end of the year. So that's an advantage of being a sole proprietor in Canada, very low cost entry to begin that type of business. Whereas, and on the other hand, to incorporate your business, a little bit more paperwork involved. You got to start getting lawyers involved. So when you're getting lawyers involved, you've already got a price tag attached to that, right? So they're going to file some paperwork for you. They're going to reserve your name with your provincial registry and or federal registry, right? You're going to have your business name, and that in itself costs a one-time fee. And then every single year after that, to maintain the status of your corporation, that same lawyer is also going to file an annual return with that corporate registry to keep your name registered with the province. That is an additional cost. So you have right there initial cost of a lawyer and then already an ongoing annual fee to keep your corporation maintained. That's one thing. The second thing is, as a sole proprietor, your taxes are included on your personal tax return. So all of the money that you make and spend in relation to your business is simply another form attached to your current personal tax return. And so your tax preparer is going to, unless you do your taxes yourself, is going to ask you for all of your personal information, right? All the normal questions. Are you married? Are you single? Do you have kids? Do you own your house? Do you own foreign property? All that stuff. And then ask you for your business income and expenses. And they're going to include that. Now, your taxes are then based on all of that income together. So if you happen to have a part-time or full-time job and you're doing your business as well, all of that income combined with your spouse's return, if you have a spouse, is all together to determine what you're going to pay in taxes. In another video, I said, as a sole proprietor, you can expect to pay anywhere from 25 to 35% in taxes. And the reason for that is because as a sole proprietor, you are taxed on both the employer and the employee taxes. So there's very little tax planning strategies that can be done on a sole proprietor business to work to your advantage. Whereas on the flip side, if your business is incorporated, that gives your accountant and or tax preparer a little bit more room to work with. So they have the opportunity now to work with some more strategies because in your incorporated business, you yourself can be an employee. As a sole proprietor, you're not an employee, never can be. You can have employees, but you can't be one yourself. In a corporated business, you can be. So therefore, you have a little bit more strategy available to you to decide how you want to withdraw your paychecks from your incorporated business. Because you can have a combination of both T4 income and T5 income, or one or the other. Whereas in the sole proprietorship, you don't have the choice. It's you withdraw and that's your money. And you're taxed on what's left over at the end of the year on your paper returns, not on how much money is taken out. That's also why you get taxed so high. So with the incorporated business, the advantage is on the tax side of things, you have some more flexibility. You can implement some more strategies to help you lower those taxes payable, which is why on the incorporated side, you can expect to pay anywhere from 5% to 20% in taxes on that business. But that's also now its own separate tax bill. So on the sole proprietor side, your taxes are all one. They're all included on the same tax return, same fee, right? One return sent off to the government, taxes payable, done. On the incorporated side, your corporation now has its own tax bill, right, to get those taxes done every year, and their own taxes payable. And then you still have to do your personal tax return on top of that. Okay. So again, separating the two when it comes to taxes. That's all going to depend on your personal circumstance. This is one of the reasons why your accountant will say it depends, because they have to take all of these variables into play to give you an educated answer, because they're looking not just at how much it costs to incorporate your business. They're going to look at the bigger picture and say, okay, well, knowing who you are as a person, maybe you have a spouse and some children and all that stuff added into and you got RSPs and you got investments, and you got all this stuff going into your tax return. They have to look at all of that as a whole to give you an educated answer so that you can make an educated decision. So taxes, one reason why you get that it depends answer from your accountant. There's a lot of variables to take into consideration. Now, a second reason, and this is the most important reason, and this is what I coach my clients on the most. The reason why your accountant will say to you, it depends, is because they're looking at your cash flow situation. So we need to remember that as a sole proprietor, there's a little bit different mindset that goes into having that type of business compared to having an incorporated business. Because the very entity itself creates its own mindset. And so we need to be aware of that. As a sole proprietor, because the legalities of it, they are personally attached to you, the person. This is where the mindset comes into play. I have a business. The money goes into all the same bank accounts. I can just do with it what I want. Whereas on the incorporated side, that mindset is it's a completely separate legal entity from me personally. So if my business goes under, they can't come after my house. Okay. So right there, we have two very different mindsets. And what usually spawns the answer, it depends, is because if your tax preparer or accountant has been a partner in your business for some time and they've been watching your behavior with money and they see that it's getting drained out of the sole proprietor business every single year, and you're always creating taxes payable and paying them off on payment strategies, they're smart enough to understand that generally what happens in your sole proprietor business, in your money behavior, is going to translate into your incorporated business money behavior. I've said it before, you do have a behavior with money. You may not realize it, but you do. And 9 times out of 10, the disconnect that it comes to business owners managing their money's cash flow is they forget that how they work money in their personal life is going to translate how they work money into their business life. It doesn't matter the type of business that you own. That's the big thing to understand. Cash flow management is not dependent on if it's a sole proprietorship or an incorporated business or a partnership or an individual or even a nonprofit. It means nothing because money is made and spent on your human behavior. So if your behavior is to take all the money out of your business, then chances are your accountant is going to say to you, not a good idea to incorporate, because if you're going to drain the incorporated business, you're not going to have any money left. There's going to be zero assets, and you're just going to show on paper that you're running it dry. And because it is its own separate legal entity, not necessarily the best strategy, right? We want to recognize the first step, and probably the most important step aside from the tax side of things, because the tax strategies, those are 100% logical. And those can easily be described to you, and you can make an educated decision on whether staying a sole proprietor or being incorporated is the best decision for you. But the number one reason as to why people should not incorporate or should incorporate is looking at the behavior of how they run their business in general. And that's why you get the it depends. Because if your spending habits are this way on this side of the business, they're going to translate to this side of the business. That's why it doesn't matter. The entity itself isn't as important as the cash management system that you have implemented into your business. And that's what I do with the profit first side of things. When I'm implementing profit first, it doesn't matter whether your business is a sole prop or whether it's incorporated. I've worked with clients, their business made $50,000 a year, doesn't matter the entity. And I've worked with clients who make $2 million a year, doesn't matter the entity. Because cash moves the same in all entities. It doesn't matter. In fact, cash moves the same in all currencies. It doesn't even matter what country you're in. Money comes in and money goes out in the exact same manner. If that's not dialed in, then it doesn't matter the type of business that you have. Because the reality is, if you have no money, you got no money, right? What we're doing with the profit first system is we're defining every dollar that comes into your business, what its job is. So we're separating it out. It could be that out of that dollar, 10 cents has to go to taxes, 15 cents has to go to sales tax, 50 cents has to go to you, the owner, to be paid, and 35 cents has to be operating expenses. But whatever that percentage is, we're defining what its job is. And because we work with the multiple bank accounts where we're physically moving the money into those bank accounts, there's always going to be money in the business, corporation or sole proprietor. So that's why your accountant gives you the "it depends" answer, because they're looking at it from a cash management type of view. Yes, they can explain to you all of the tax logistics, and you can definitely make your decision based on that as well. But in reality, it's the cash that makes the biggest factor in deciding whether you should incorporate. Because if you don't have a handle on managing your cash, it doesn't matter the type of business you have. In my other video, I told you how I created myself a 5-figure tax debt. And it was because of the profit first system, it transformed how I look at my money so that when I did incorporate my business, I now have that asset sitting there growing for me. But the main thing that I wanted to bring to you today in this video was to give you all of the different variables to think about when you are wanting to go from sole proprietor to an incorporated business. It is 100% doable to do in either situation. But the most important thing you need to remember, you have to do what's right for you. I can give you all the advice that you ask. Your accountant can give you all the advice for you ask. But if you don't feel comfortable doing it, don't. That's just the reality of it. I coach clients and bookkeepers all the time, and my main message is always you do you. So take the information that you're getting, sit with it for a little bit of time, however long that time is, but don't let it go on for too long and keep you stuck, and then make your decision. And whatever decision you make, just be at peace with it. That's really what it comes down to. If it's comfortable for you to go ahead and incorporate, then go ahead and incorporate. I hope it gave you some clarity and some answers to the question, it depends, so that you can make the best decision that's available to you. And if this video gives you something to think about, I'd appreciate it if you hit that like and subscribe button, and or maybe share it with somebody who also needs to hear it too. Your future self will thank you for it, and I'll catch you in the next video.